Good afternoon, everyone. This is Steve Janikowski with Brown Janikowski. Recently, we held a client event, and since many of our clients are out of the area or otherwise could not attend the event, we've created this webinar version. Over the past several years, the U.S. Federal Reserve and other world central banks have created a tremendous amount of monetary stimulus in an effort to jumpstart the economies. What we've seen instead is a slowdown or very tepid growth of economies rather than a major ramp up. The byproduct of this monetary stimulus, however, was a ramp up in stock and real estate values here in the US, Japan, China, and now starting in Europe. However, as the economies seem to be sputtering backwards and slowing down rather than accelerating, we've experienced a correction for the first time in quite some time in the third quarter of this year. This table shows some of the downtrend in the various indexes over the past 3 months. So, for example, at the top row, the S&P 500, which is the broad U.S. stock market, declined 6.4%. The MSCI EAFE, which represents foreign stocks, declined 10.2%. The MSCI EM, which represents emerging market stocks, declined 17.9%, and there are additional indexes below that. So when you opened your custodial statement for the month of September, you would have noticed that your portfolio value had declined, and here's the reason why. However, we've seen a significant uptick in October values, so when you get your October statements, you should notice a significant upturn in your portfolio values as well. The third quarter decline caught many investors off guard. And I guess this is natural since we haven't had a decline in quite some time now. This chart of the Standard & Poor's 500, which represents the U.S. broad stock market, really represents how volatile the market is. So if you notice, there are quite a number of peaks and valleys along the way over the last 6 years since the low point in March 2009. I superimposed a blue line on this chart to show the growth trajectory for the market. But as you can see, it doesn't really move in a straight line, but there are a lot of ups and a lot of downs. The green numbers at the top of the chart represent the up cycles, and there's the percentage return on the up cycle as well as the number of days that the market was up. And on the downside of this chart, the red numbers represent the down periods or the corrections along the way. So you can see the negative returns as well as how many days the stock market had been down. So when you look at this most recent period of what happened in the third quarter, it really isn't unusual at all. It really follows a pattern of these up and down periods or periodic volatility or cyclicality in the stock market that we've had for as long as the stock market has been around. Now, if you watch the financial news media, CNN, CNBC, Bloomberg, and some of the others, the talking heads love to talk about all the reasons that the stock market went down. Here are a number of primary reasons that the media has focused on. In our view, there are 3 primary factors driving the global economies and markets. And we've displayed them pictorially on this slide. To the left, a picture of Janet Yellen on the cover of Time magazine as she was sworn in as chair of the Federal Reserve Bank. Now, it's not just about Janet, but really we're citing that the central bankers around the world hold tremendous power and really are, in our view, probably the key determinant of where the economies and the various markets are going. 2, above right, we see a pictorial of China. China is the second largest economy and also the second largest stock market. Well, China is going through a painful transition at this point from being an infrastructure building economy where they've imported tremendous amounts of commodities and built highways, buildings, apartments, and now have slowed down and are in the process of transitioning to a consumer-led economy. But it's a painful transition, one they're not used to, and we've seen their growth rates slow significantly. We've seen a boom bust in their stock market where it's rocketed to the extraordinary highs earlier this year and then busted and crashed to extraordinary lows, giving up almost all the gains later in the year. And the economy is, in our view, sputtering. They're skirting recession. Central bank is very aggressively easing and concerned about the stock market, also propping up its stock market. And then lastly, to the lower right, oil. Oil is more than just a commodity, but it's a significant driver of economic growth, or in this case, economic slowdown. And it isn't just a handful of countries that are affected, but all countries are affected by what happens with the price of oil. Clearly, exporters are hurt because of the low prices in oil, but with this crash in oil prices, which mirrors to some extent what happened in 2008 and 2009, it's a net drag on the overall global economy. There is a little bit of a silver lining in that it's like a tax cut for consumers, for some companies that are heavy oil users, and also for countries which are oil importers. But net, overall, it's been a drag on the global economy. So these three major forces that I mentioned play out, and let's take a look at how they've affected these various major global economies. At the top, the U.S. economy, we've had slow, really relatively unexciting growth, but it seems to be relatively stable. The central bank, what they're up to on the right, the Federal Reserve has been accommodative, but indicated that they plan to raise interest rates. China has been slowing, as I mentioned, and they are transitioning from this investment to consumer economy. And again, it's painful, and they're skirting recession. Their central bank is easing and providing tremendous amounts of monetary stimulus and support to their stock market. Europe is in the early stages of recovery. They've been in the doldrums for some time now. Their central bank has embarked on an easing program somewhat similar to what the U.S. did a number of years ago with a quantitative easing program. Japan, well, they've been on a monetary stimulus program for quite some time now. I'd say monetary stimulus on steroids. Some months it appears they're gaining traction, and other months it looks like they're falling back again. So I would say characterize Japan's economy as sputtering, and it's not really clear yet if they're out of the woods. And lastly, the emerging market economies, which encapsulates a tremendous number of economies. Well, most of them are caught in China's slowdown orbit. Their central banks are trying to ease, but again, it's a painful recovery for them simply because China is such a large influence on their overall economy. Earlier, we mentioned that the financial news media puts out tremendous amounts of data, and it can be quite confusing at times because there's so much data and so much information that becomes mind-numbing. And this pyramid represents how we like to think about the amount of data and information, which is really base information, not very useful by itself. It's just little factoids. The question is, what do you do with this data? And until you can analyze the data to get insight, which would lead to knowledge and wisdom so that you can make intelligent decisions about managing your portfolio, it's not very useful. Some of the questions we're asking as we watch the global central banks, especially the European Central Bank as they embark on their monetary stimulus, Japan as they continue, China, what they're doing, and U.S. is quantitative easing and other forms of monetary stimulus have been an elixir, not so much to the economies, but to the various stock and real estate markets. Question, will it continue to have a magical effect on asset prices, or are there unintended consequences, or does it lose its magic? This is an interesting question. Jury's still out here. The Federal Reserve has indicated that it plans to raise interest rates, and most investors and much of the financial pundits and media believe that interest rates are on their way back up. But are they? Are rates really going to go up? This chart's interesting because it shows a long-term trend of interest rates going all the way back to 1914. This represents the discount rate, which is the rate the Federal Reserve Bank charges its member banks if they need to borrow from it. You could see back in the 1930s, interest rates for the discount rate were around 2.5%, and they dropped down to 1% in the mid-40s. But it took almost round trip about 30 years to go down from 2.5 back up to 2.5%. So even though history does not repeat exactly, there are some similarities between that period and this. For example, it was a very slow economy. There was the deflationary effect, and the economy just really had a hard time picking up speed. Well, we didn't go through the same circumstances, but we have similar conditions with somewhat deflationary conditions, very low inflation, and very, very slow economies, not just in the U.S., but on a global basis. So investors seem to think that, well, interest rates are low, but they need to climb back up to where they were back in the late 1970s, early 1980s. But do they? There's experience that they've been low for quite some period of time. And this one maybe is a little bit tongue-in-cheek, but this is a very, very long-term chart dating back to 3000 BC. You'll probably get a chuckle out of some of you. This was put together by one of the officials at the Bank of England when he was quizzed as to why does he think interest rates can stay down, or why does he think interest rates are as low historically as they've ever been. He went through an exhaustive research process tracing through a number of civilizations and country statistics to put together this piecemeal chart of interest rates going back. Now, obviously, the interest rates in the 3000 BC are probably very unreliable. However, when we look at the rates in the 1700s and 1800s, there's more reliable data. So you do see a pattern that interest rates have historically been in this low single-digit to mid-single-digit range for centuries. And where we look at where we are today, it really is about as low as they've ever been. The only time they were clearly this low was back during the Depression in the early 1930s. So again, in summary, it's not clear-cut that interest rates are going up anytime soon. In fact, if we keep these fairly slow growth conditions in a deflationary environment, rates could stay low for quite some period of time, regardless of what the Fed Reserve does. So where are the values today? So we've tried to summarize some of where the major markets are, and I won't go into tremendous detail here. There's a lot of detail, but I'll try and keep it simple. We list a number of different indexes. So the S&P 500, again, broad U.S. stocks, has a price to earnings multiple. That means if you take the price of the index divided by its earnings, it gives us a ratio, and that ratio we can look back historically and say, well, is that high? Is that low? Is that expensive? Is that cheap? Well, most recently it's about 15.4. To the right, you'll see the 10-year average price to earnings, or PE multiple, which is 14. So it's slightly higher than the 10-year average. So we would say it's a little above average, but not super expensive, but definitely not cheap. Below that, MSCI EAFE, which are foreign stocks, price to earnings multiple of 13.7, and a 10-year average PE of 12.8. Again, a little bit more expensive than the long-term average. However, Europe has been in the doldrums, and so the earnings are very much depressed. So if we see a pickup in earnings, their stocks, if the price doesn't go up, the PE multiple will go down very quickly, in which case it would reflect that their market is relatively cheap. And lastly, I'll cover MSCI EM, or emerging markets, price to earnings multiple of 10.7, the long-term average 11.2, a little cheaper, but again, remember that these are very depressed earnings, so if we see any pop in earnings as the economies recover, that market has very strong upward potential. I do have energy, infrastructure, and real estate, and I'll just say commentary without going all the detail that we believe that real estate is reasonably priced but still in a nice upward trend, and energy infrastructure we actually believe is very inexpensive at this point from a historical basis, offering some fairly generous distribution yields, which are tax sheltered to some extent for taxable investors. And if you think about the volatility in the capital portion of the investment, which is bouncing around, you're getting paid while you wait for those recoveries. But the yields are very, very attractive, especially in this low rate environment. Going into a little bit more detail about where we see some of the values, when we look at international equities, mentioned that they seemed a little bit cheap relative to US, this chart puts it in a little bit better perspective on a continuum. There's a ratio we calculate between MSCI EAFE, or foreign stocks, relative to the S&P 500. So that ratio is represented here. The baseline, the red line we've drawn, is average, meaning that whenever the blue line, or that ratio, is above the red line, foreign stocks are expensive relative to US stocks, and whenever it's below the red line, foreign stocks are cheap relative to US stocks. Well, obviously, foreign stocks have been cheap relative to US stocks for quite some time now, and highlighted in the little blue circle, that it's actually gotten more extreme, where they've been cheaper on a relative basis than they've been in a long, long time. So if the European economy does start to recover and their quantitative easing program has this magical elixir effect as it has in the US and in Japan and China, we would expect to see this gap between US and foreign stocks narrow quite dramatically. It doesn't mean that foreign stocks have to become more expensive than US stocks, but there's a lot of catching up to do, and we actually really like foreign stocks at this point. And lastly, we're going to take a look at emerging markets. I mentioned that these are depressed as well, and this chart reflects it again on a easier to see basis, or a continuum. So this chart plots emerging market stocks relative to developed market stocks. So the higher the level on the chart, the more expensive emerging market stocks are relative to the developed stocks. And developed stock, we're talking about all the larger economies, foreign economies. So you can see how cheap emerging market stocks were in 2003, which is on the far left-hand side of the page, and then they'd gone up and become much more expensive, and they've drifted back down over the last several years, almost decade really. And if you notice, emerging market stocks are now as cheap as they've been in 2004, which is quite some time ago. In fact, over the last 5 years, to tell you how bad it's been for emerging market stocks, they've averaged about -2.5% to -3% per year for the last 5 years. So there's some catching up to do, and this is an area where we would expect to see explosive growth once we start to see these economies recover. And lastly, in the portfolio, folks who are concerned about interest rates going up wonder, should they sell all their bonds? Well, bonds still have a place in our view in a portfolio. First of all, they do generate yield, even though the yields are lower, but that's better than cash, which is earning almost zero. And at the same time, they also provide a buffer or cushion when the stock market goes down. What we tried to represent here is how bonds have done whenever the stock market has gone down. So on the left side of this chart are periods where the stock market went down, and you see those years. To the right, we reflect during that same period where the stock market was down, what did bonds do? And you'll notice, except for one period in 1969, every time stocks went down, bonds actually made money. So not only did they act as a shock absorber by not losing money when stocks went down, they actually made money. So bonds, in our view, still have a place in the portfolio despite the fact that interest rates are low. And we feel that they will continue to be good yield generators, and their yields will go up as interest rates do gradually start to tick up, and they will continue to act as shock absorbers for what we believe will be continued volatility in the stock markets. So what do we do as investors? So we've summarized some of the important bullet points that we think we recommend to our clients and to other investors. 1, stay in bonds, especially U.S. and developed foreign, for the reasons we just discussed. 2, U.S. equities will bounce back from this correction. We've seen it on the long-term chart of the S&P that we had up a few slides ago. It's gone down, but it goes right back up again. 3, be prepared for bumps in energy, commodity, and emerging markets. These 3 areas have been weak the last 2 years, but remember, what was weak becomes strong, and what was strong becomes weak. There's always a cyclicality in all the markets. We would expect to see a rebound in energy and emerging markets in particular over the next several years. So these are areas where we think that there is good value. 4, but at these levels, downside is more limited. So some people are concerned that if they have been invested in energy-related investments or emerging markets, that maybe they should get out because it's going to continue going down. We feel the downside has mostly happened and that the further downside is very limited. 5, MLPs are down. That's the infrastructure investments. But you're getting paid to wait, and the income is important. Remember, I had mentioned that energy infrastructure investments now have yields that are very generous, somewhere between 8 to 10%, in some cases even more, and often tax sheltered to a large extent for taxable investors. Plus, they've had a history of having increasing dividend distributions. 6, some international markets are at cyclical lows and represent long-term value. We just looked at that with foreign stocks as well as emerging market stocks. We consider these really good places for long-term value. 7, alternatives provide some buffer. Use them. We're in an era where there are more investment opportunities available to investors than there were a decade ago or a decade before that. It used to be you only had access to stocks or stock mutual funds, bonds or bond mutual funds. Now there are all sorts of different alternative investments which have different profiles on growth, income, and don't necessarily correlate or zig when the stock market zags. So we think these are important components in a diversified portfolio, and we believe they have a place even if they're temporarily out of favor. Stay diversified. It's tough to chase what's been hot, and generally what's been hot gets cold and vice versa. And lastly, Bloomberg usually is better than CNBC, but don't act on either. Thank you very much for sitting through this presentation. We hope it has been helpful, and we hope we get to see you at one of our future client events. We tend to schedule those on a monthly basis in each of the different geographies in the Bay Area. And again, for our clients who are out of state or out of the area or who are unable to attend, we intend to create webinars of these client events and post those on our website shortly after the client event. So thanks so much and have a great afternoon. Take care. Bye-bye.